Hi, welcome once again. So, we have looked at financial performance management, which covers both the numbers and the non financials. Okay, we've looked at how financial reporting or corporate reporting has evolved over time. And we have also looked at the management accounting topic of cost benefit analysis, break even analysis, right? So, you realize that the numbers are still playing a key role there. Let's look at some dimensions of performance management, which is non-financial. I mean, it has some components of financial, but then let's do a quick recap over what we have looked so far, and then we can take a good look at the non-financial component. I don't want to say non-financial because it got some financial dimension. The balanced scorecard, which was developed by Kaplan and Norton sometime 1992 and later upgraded 1996, and today it's been a very good tool to be used. All right, let's look at it. So at the end of this session, we wanted to still appreciate the difference between financial and non-financial performance indicators and the four dimensions of the balanced scorecard, namely the financial perspective, the customer perspective, the learning and growth perspective, and then the internal business processes. Okay. And then we want to link the balance scorecard to strategy formulation and, of course, to financial outcomes. At the end of the day, maximization of profit is good, or wealth maximization for shareholders is key here. What is the purpose of a business? Just a recap. We said businesses exist as going concerns to enhance the wealth of its owners. They do this by maximizing sales and profit. They achieve some target market share and, of course, market returns, and they maximize long-term shareholder wealth through appreciation of its stock prices, and earning yields and so on and so forth. And of course, they exist primarily to survive. But also, we say businesses should consider providing good working and conducive working environments for their employees. They should not destroy the ecosystem, the habitats in which they exist, with the local communities, which gives them the legitimacy to survive. Don't destroy it, conserve it for posterity's sake. That is sustainability, okay? The ability for us to enjoy our benefits today so that posterity will not be shortchanged without compromising the ability, the prospect for future generations to also enjoy theirs. That's sustainability. Again, businesses should develop safer quality products for their customers, and they should offer fair trading terms for suppliers in underdeveloped countries. Okay. So if there's a company who employs child labor, who pays below the living wage or below the minimum wage, you don't want to work with such people. There are a number of stakeholders in the business who have conflicting interests. So the customers want quality products. Owners want increase in their share prices or in their stocks, in their wealth. Lenders want you to pay them on time and also pay the interest. Don't go into default. Managers want to run the business well. They get some bonuses based on the profits which they make. Regulators want you to comply with laws and regulations, okay, with the acts. The staff wants job security. They want a safe environment to work in. They want an organization with a good corporate culture. Then suppliers want fair trading terms. Everyone is pulling one end of the slice. So you will see some conflicts happening here and there. For example, owners want you to get them good profit, good dividends. But at the same time, the community also wants you to provide them with some scholarship schemes, some good potable drinking water. So what happens? We are all pulling the same profit. We all want some benefit from it. Okay. And then we will talk of evolution of corporate reporting, where it's migrated from the 1960s, purely financial statements, getting to the 2020, 2022s. Now we have more of non-financial information in the annual report. Okay. So we've seen financial reports evolving into integrated reporting with its six multiple capitals: the manufactured capital, the social and relationship capital, the financial capital, the intellectual capital, human capital, environmental capital, or the natural capital, all coming together to be reported within the integrated reporting framework. Okay, and today they've all joined forces, the International Integrated Reporting Council, merging with the Sustainability Accounting Standards Board to form the Value Reporting Foundation. Sustainability. Today, they've connected with the IFRS Foundation and they are reporting on IFRS S1 and S2. It keeps going on and on and on, because the idea is that let accounting professionals, let finance professionals also contribute towards the concept or the issue of sustainability, right? We looked at financial versus non-financial information. What are the differences? Financial information is expressed in monetary terms. We find them in the financial statements. Examples include the profits, the net income, the sales, the gross income, the expenses, the research and development, investment, dividend per share, dividend yield, earnings per share, price earnings ratio. You find them in the financial statements. The non-financial information, anything that is not expressed in monetary value, but can also be found and can not be found in the financial statement, but you sometimes find it in the narrative, the management commentaries, the sustainability reports, the CSR reports. Okay, we don't normally express these things in monetary terms, so you don't find it in the financial statements. Okay, so examples will include suitability of the stocks, the environmental, social, and governance information, relationship with suppliers, with customers. Okay, and this feed into what we call the some example into frameworks or tools like reporting tools like the Balanced Scorecard, the integrated reporting, the ESG disclosures. Okay, we've looked at integrated reporting. Let's move on and see. Strategy has a link with performance management. Strategy is our game plan, the overall picture, the bigger picture. Where are we heading to? Okay, so we have our mission. Why do we exist? Typically within the short term, measured within the short term. Then we've got our core values, what we believe in. So you see integrity, respect, teamwork, collaboration, inclusivity, diversity, right? Core values keeps us going. We believe in something, like a culture, And then we've got a vision, what we want to become, which is our strategy, the bigger picture, the game plan. So the goal of performance measurement systems is typically to measure, monitor, and report on our current factors, critical success factors, and future critical success factors, which helps us to execute our game plan. It helps us to execute our game plan, our strategy. Now, strategy in particular deals with the means by which we as an organization will seek to fulfill our mission, why we exist, to help us move towards our vision, where we want to be, within the context of what keeps us going, our values. So strategy is more or less trying to bind these three elements together. Okay. There are some strategies people use, like Porter gave us three kind of strategies organizations use. We have the cost leadership strategy. Simply put, cost leadership is saying you produce your goods and services at minimal cost compared to what rivals or competitors are doing. So if I can produce this iPhone or this particular phone or this particular vehicle at a minimal cost without compromising quality anyway, that's what you should look at. And the competitor can produce the same thing at a higher cost, then I am using more of a cost leadership strategy. One thing you would find is that iPhones, take any iPhone or any Apple product, you see they've indicated designed by Apple in California, assembled in China. So you realize that why do they assemble it in China? Because they're going to get very lower cost of labor. If they were to assemble it in the US, maybe somebody would charge $40 an hour. But if you go to China to assemble it, they could charge maybe $10 an hour. Okay, cost leadership strategy. Then we've got differentiation. Differentiation means position your product to be different from that of competitors. So you take an iPhone, for example. iPhone hardly takes in a micro chip, storage chip, right? Unique. It is known for its strong battery life, not easily infected by viruses. Compared to the other phones, an Android phone, I'm not being discriminatory like Samsung. Samsung is prone to virus attacks. Trust me, I've used Samsung, I've used iPhone, and comparatively, I've never had any issues with iPhone being attacked by viruses. The battery life, wow, you will love iPhone compared to Samsung phones. Things change anyway. People always improve their way. So what we are saying here, differentiation, is that your product is unique compared to what competitors will provide on the market. Then we have a focused strategy. You focus on a particular niche group. Maybe this product is targeted at students. So you will see sometimes Lenovo or Acer or ASUS laptops, they will tell you these are purely for students, for university students. So they design it in such a way that it meets the needs of students. They are targeting that particular niche group. Some will target maybe a middle class, some will target the higher class. So you talk of the expensive, luxurious cars are focused, they produce it luxurious so that the big guys at the top can buy it, right? So those are strategies that organizations typically use. The Balanced Scorecard, which is the heart of what we're looking at. So developed by Kaplan and Norton in 1992, later updated in 1996. It's a measuring tool. Okay, it's a measuring tool. It's not comprehensive enough. How do I explain this in a normal term? So just as you would use the income statement to measure performance of the company in terms of the profits and losses which they make, just as you use the statement of financial position, the balance sheet, to measure the financial position, the snapshot of the company at a particular time, just as you would use a statement of cash flows to assess the liquidity status of the company, the same way you can use the Balanced Scorecard to assess the non-financial, inclusive of some elements of financial performance of the company. Okay, so it touches on four main dimensions. So the Balanced Scorecard is also a performance measurement and monitoring tool. It helps the company to align its strategy to four main dimensions of the company's operations. Number one, the financial perspective. Simply put, how does the company appear to their shareholders? In order to succeed, how should they appear to their shareholders? And then, so you have to look at the goals, the measures, the targets, the initiatives. From here, I'll show you one thing, then it will help you, okay? Today, we've got AI tools, which will help us draft or develop the Balanced Scorecard. We don't want you to rely so much on AI. AI is good. Use it ethically. We'll try and attempt something and see if it works. Let's go to the second dimension. So the internal business processes to satisfy our customers and shareholders. What business processes must we excel at? Or what is unique about us? In which areas do we excel? That's the internal business processes, okay? Learning and growth, like the name sounds, is typically talking of how to improve. Capacity development. What do we learn? How do we grow? So to achieve our mission, how will we sustain our ability to change and improve? Through learning, through growth, okay? So we can look at the goals, the measures used to aligning to the goals. Some people use the KPIs, okay? And then the targets we want to set and the initiatives we will take to achieve this. So you have to draft this. You can draft this, okay? And then the customer perspectives to achieve our mission, our vision. How should we appear to our customers so that we can retain the existing customers and we can attract new customers? Okay, that's the Balanced Scorecard. That's the Balanced Scorecard. So typical examples here too. For the financial perspective, you can look at return on investment, economic value added, ROCE, revenue growth, cost reduction, return on shareholders fund. Okay, so you can set an objective, for example, revenue growth. We want to increase the number of products We want to develop new customers and markets. We want to change to a more profitable product mix. How do we measure this? Look at the percentage of growth from new products. Look at the percentage of revenues from new customers or markets. Look at the sales growth percentage for target segments. You could also look at an objective like cost reduction. We want to reduce product or service cost per unit. And we want to reduce our selling and distribution cost. How do we measure this? Consider the percentage reduction in cost per unit. Consider the percentage to total revenues of selling and administrative costs. Is more or less like doing a vertical analysis or a common sizing, right? And then we talk of another objective like asset utilization. We want to improve asset utilization. So talk of the return on investment and economic value added. So this was pulled from Drury's Management and Cost Accounting book. Very good book. You would love it. For the customer perspectives, you can look at customer growth, customer retention, customer satisfaction cost, product return rate, defect rate, on-time delivery rate, after-sales services, name them. So an example of an objective you could cite, like increase market share. So look at your percentage of market share. Increase customer retention. Look at the growth, percentage growth in business from existing customers. Look at the increase in your customer acquisition, so your total sales to new customers. An objective like increasing customer satisfaction. What is the survey ratings or satisfaction ratings which came out? And another one like increasing customer profitability. Look at the customer profitability analysis, right? Again, an objective like customer value propositions, which looks at improving product functionality, decreasing the price relative to competitors, improving product quality service, and improving delivery time with the corresponding measures stated over there. The next one, we're looking at internal business processes. At what business processes must we excel to satisfy our partners, our stakeholders? So you're looking at product development cycle time, order to delivery response times, the Six Sigma approach. Some would want to use the business process re-engineering, new product, service introduction rate, so on and so forth. Let's take one or two objectives and measures. So, for example, innovation. You want to increase the number of new products. So measures could be percentage of sales from new products. Okay. For operations, you can look at increasing process quality. So talk of the total quality cost as a percentage of sales. For sales services, you could look at increasing service efficiency. So look at the output-input ratios. Right. Good. And then the last one, the learning and growth. What people and systems do we need to sustain our ability to change and improve? So there's some measures like employee retention, turnover rate, salary wage index, training development, hours per employee, value added per employee dollars, right? An objective could be increasing employee capabilities. How do we do it? Measures like sales revenue per employee, employee satisfaction survey ratings. An objective like increasing information systems capabilities could look at percentage of processes with real-time feedback capabilities, percentage of customer-facing employees having online access to customers and product information. And you could look at another objective like increasing motivation, empowerment, and alignment. And the measure could be the number of suggestions implemented by employees, the number of suggested improvements per employees, percentage of employees with personal goals aligned to the Balanced Scorecard, and percentage of employees who achieve personal goals, right? We're wrapping up. So this is a typical example of Southwest Airlines Balanced Scorecard framework. I'm not going to go into it, but I just want you to see something. You could see that they are all linked. The ground crew alignment from learning, what they are saying is that if the ground crew are well trained, they are well taught, they've been given enough training, what will happen is that there will be fast ground turnaround time. So that the airline lands and they quickly do it because they've been trained, right? What will happen? This will ensure that there were fewer planes waiting on the tarmac or whatever, and there will be more customers because flights will be on time. and flight could be at a lower cost. So you see how it is connected to all of the dimensions. The reality is that a very good balanced scorecard is interlinked to all the four dimensions. All right. So when you're constructing a balanced scorecard, you must make sure they are connected. Sometimes you hear strategy map. Same thing, all right? Now I'm going to end here, but I'm not really ending. I want us to look at one item just for you to give it a try on your own and see whether this works, okay? To see whether this works. So I'm going to open an intentional chart GPT, okay? And then I want us to look at what we can do with it. And did I say chat GPT? It's not chat GPT actually. So let's see. So I'm going to share my screen. So I will intentionally want you to ethically use AI to help your studies, okay? So I have opened this. I'm sure you can see it. So I use DeepSeek. And I come in. Let's try something. So construct a balanced scorecard for let's see anyone. Let's see Pepsi. Cool. And present this in a tabular form. Right. Let's try this and see whether he can help us. So even if he presents this for us, what we have to do is that we have to rewrite it. Okay, we have to rewrite it. So it is populating this. Let's give him just a couple of seconds and you would see that he has done a very good item, a very good something there for us. And then we will have to update it. That's all. So use AI ethically. Use it to get ideas, perspectives, and then you modify it, you paraphrase it. Don't just copy and paste what he's done because he's not provided us with references. He's just giving us what he thinks based on general knowledge. AI is good, but typically AI is generic. So you have to now modify it to specific, okay? So let's take an example like this. So you can see I may have moved this thing slightly. I don't know why. Okay, this one. So let's take a look at this. You can see the perspective. Let's just take one. To succeed financially, how should we appear to our shareholders? Okay. Now you see the objective, strategic objective, what we want to achieve. Deliver profitable growth. And how does it do it? It says that key performance indicators or measures, what we saw as measures, organic revenue growth, core constant currency EPS growth. Say that he's made it more generic. Okay. But we can now change this and say percentage of growth in revenue over the last 2 years. So we will now modify this, that percentage change or percentage growth in revenue from traditional products over the last 2 years. Do you get it? Net revenue per employee. This sounds okay for me. So I would rather change this and say total or revenue or total revenue per employee. Okay. Or so how do I find it? So if you want to get the measures, how to measure this one, it will be total revenue divided by number of employees. That will be the initiative or how I can easily measure it. Okay. Or this is a KPI, yes. So I will change this as total revenue per employee. So here is using net revenue per employee. So what I'm saying here is that, listen, you could always use AI ethically, but what you have to do is what? You have to paraphrase it and change it so that it portrays reality. So I can take the annual accounts of Pepsi and then align it to this and then rewrite everything. This one has given me the framework, the general perspective, that I can use this one. I'll open the annual accounts of Pepsi and check whether their strategic vision is actually to be the global leader in convenient foods and beverage by winning with purpose. Is it what is really in the account? If not, I'll update it. Okay, but I'm very sure it will be closer or the same. All right, so this is where I end. When you are asked to develop or construct a balanced scorecard, use any available tool you can. Don't rely fully on AI. It is generic. You would want to add some professional and academic references to make your work excellent. All right, friends. I'll leave you here and I'll see you on the other side. Thanks. Bye for now.